Good morning everyone and welcome to chapter 6. In this chapter we are going to talk about tax and retirement planning. This is a pretty important chapter. So a lot of focus on this chapter is going to be understanding the taxation structure, understanding the products like registered retirement savings plan, tax-free savings account, as well as other retirement solutions that Canadians have. Very important for the exam also. Like in exam you will find questions from this chapter for sure. Okay, so first of all, how does the Canadian taxation system works? So all investors that you will meet in your life as a mutual fund advisor, they want to lighten their income tax bracket, and they do tax planning, which is an ongoing process, just not something that is done at the beginning of the investment plan. So important objectives that an advisor is going to have is to minimize the tax burdens for their clients in a legal way, in a tax planning way. The best tax advantage are usually gained by planning early and planning often. The investors, your client, must always keep in mind that it is not the nominal income or returns on their investment that is important, but after tax income is important. For example, if your client has rooms in two accounts, he has let's say $5,000 to invest, and he has $5,000 room in his tax-free savings account. At the same time, he has $5,000 room in his non-registered account, right? So we'll discuss this across course, but tax-free savings account, whatever money you invest in that, right, in whatever instrument, it is tax-free. The growth is tax-free. The returns are tax-free. So the returns from a tax-free savings account for same investment you make is not the same as returns that you get from a non-registered account in which the income is taxable. So when you plan for your clients, it is important to consider the tax status. So choosing an investment based only on low tax status now does not make sense in the end, right? Sometime into the future, if the end result is lower after tax returns later. So it's important to consider the tax status of your client, the tax planning for your client. Now, tax avoidance is illegal. Tax avoidance means we either don't show our income, which is not legal at all. You have to mention all the income you get in a given year. Or tax evasion could be like doing funky things, right, which are not legal. So tax evasion is illegal, but tax avoidance, that is planning, is entirely legitimate and is most commonly found in the following. So these are few tips that you might want to share with your clients when you advise them on taxes. They need to utilize all allowable deductions and credits, right? Whatever credits are there, they need to fully utilize that. A common one is whatever you spend on medical expenses, right, that may be used, those expenses may be used as a tax credit. Then if you have a child care expense, right, if your client is hiring a nanny, right, those expenses can also be utilized for getting a tax credit or a tax deduction. So it's important to utilize all the possible ways that a client has for reducing his tax burden. Then converting non-deductible expenses into tax deductible expenses. So finding ways of converting things into a tax deductible expense. Then you can postpone the receipt of income. Rather than getting income right now, you can defer that income. An RRSP is this case, right? When you invest in an RRSP, a registered retirement savings plans, which we'll discuss in the course, right, in this chapter, you get a tax deduction. That tax deduction means it lowers your tax income right now. But when you withdraw from the RRSP account in your retirement, you have to pay taxes. So you're deferring the receipt of that income. You're deferring the impact of that taxes. Then you can split income with other family members. There are a lot of restrictions regarding it, but there is certain retirement income that you can split with your spouse and like take additional tax credits, right, which we'll talk as we proceed. Then you can select investment that provides better after tax returns, right? So famously, or like in Canada, when you get dividends are taxed at a lower rate than interest income. So if your client is in a very high tax bracket and they have invested using a non-registered account, right, so that account is taxable, then you might focus for your client more on dividends rather than interest, because dividends are taxed at a lower rate in Canada. Now, how does the income tax system in Canada works? So the federal government imposes the income taxes, right, by the federal statute, right, which is the Income Tax Act. All Canadian provinces have their separate taxation system that imposes provincial tax on residents and non-residents, but who conduct business or have permanent establishment in the province. But how does it usually work? You pay taxes only to one entity, that is the federal government. When you file for your taxes, you pay a tax to CRA. Now then CRA from that taxes distributes the provincial share to the provinces. It happens in most provinces except Quebec. Quebec does not do that. Okay. The federal government collects the provincial tax for all provinces except for Quebec, which administers its own income tax on individuals and corporations, and Alberta, which administers its income tax on corporations. So two provinces, Quebec, right, you have to pay taxes separately to the government of Quebec if you are an individual or corporation. In Alberta, if you are a corporation, you have to pay taxes separately to the province of Alberta along with the federal tax. Now, as an individual, the taxation year for us is calendar, that is 1st of January to 31st of December. Whatever income we generate in that time period, we have to pay taxes on that. For a company, right, they can choose their own taxation year. So like the company that I run, right, the taxation year is like it starts from July, right? 1st of July, the taxation year starts. So July to June, the end of June, that's our taxation year. So a company can choose. The limitation is it cannot be more than 53 weeks. The taxation year for a company cannot be more than 53 weeks. Individuals cannot choose. So as an individual, as a client that is coming to you, their taxation year is going to be 1st of Jan to 31st of December. Now, how do we calculate taxes? So these are the 4 steps that like tax planning involves. So we calculate all sources of income for a client. So income from employment, job, income from business and investments. Then from that income, we take deductions. So deductions lower our taxable income. Whatever deductions you have, it lowers our taxable income. After deductions, we calculate the gross tax payable on the income. Okay, so once we have the taxable income, we calculate taxes, and after that we take credits, right, to get the net tax payable, the tax that is due to the government. So just to brief up on this, like I can show you like how it actually, like in a simplified way, how will it work. So let me open a Google sheet. Just examples. I'm not going in detail because the course is mutual fund. It doesn't have like detailed focus on taxes. So let's say you have income from different sources. You have your job, you have your business, you have some investment income, rental properties and stuff. So all that income put together is $120,000. So this is your gross income. Okay. From that, you take deductions. So what are deductions? Deductions are things that reduce your taxable income, reduce your gross income. So example will be an retirement plan contribution. I'm just giving an example. Okay, so let's say you contributed $20,000 to a retirement plan. So after deductions, the taxable income on which your taxes are going to be calculated is 120 minus 20,000, $100,000. Let's assume the tax based on the tax brackets this year is going to be $25,000 for you. So you pay $25,000 tax, which is calculated based on different tax brackets. Then you get you have taxable income, you calculated tax, right? Now from this tax you might be eligible from some credits. So $100,000 was taxable income. Based on that we calculated tax, but you might get some credit. Let's say you have a $2,000 medical tax credit. I'm just making something up. So the net tax that you have to pay is $25,000 minus $2,000, $23,000. So this is how the taxation system works. So you need to be very clear what are deductions and what are credits. Deductions lower the taxable income. Credits lower the tax that we have to pay. So credits lower the taxes directly, deductions lowers the taxable income. Okay, now there are 4 types of income, right? You have to gross it up, right? Which are employment income. Employment income is on a gross receipt basis. What does this mean? From employment income you cannot have deductions for employment. For example, if you run a business and you have a car that you use for the business, the expenses that you have on the car for the business purpose can be taken as deduction. But if you're salaried somewhere and you use a car to get to your job, then you cannot take that expense of the car as deduction. So employment income cannot have like lot of deductions. There are some deductions like union fees and stuff, but mostly it is on a gross receipt basis. Then you can have income from capital property, which is assets purchased for investment purpose, such as stocks, bonds, mutual fund might give you some income. Then you can have income from business. Right now, this income from stocks, bonds and mutual funds is the yearly income that they provide. It is dividends and interest income. It is not income when you sell it. Okay, that is capital property income. Then there is business income. If you are doing some self-employment or if you run a business, then you get business income. Business income is on the net basis. That is, whatever you spend for doing business, you can take it as a tax deduction. And you have capital gains and losses resulting from sale of capital property. So when you sell stuff and you make some money, right, because the price at which you sell is more than price at which you have bought it, then you make some capital gains, right, which is due to selling of property. It could be your rental property, it could be some stocks, it could be some mutual funds, etc. The next topic is, as long as an investment is held in a registered plan, tax does not apply on the revenue generated by the investment. So registered plans are, let's say, registered retirement savings plan, RRSP, or a tax-free savings account. When you invest in those accounts, then the tax treatment will be different. You are not taxed every year. You don't have to pay taxes every year. In the case of tax-free account, you don't have to pay taxes at all. In a registered retirement savings plan, you do have to pay taxes, but when you withdraw, right? Not when you invest, and not yearly. For investments that are not held in a registered plan, the investor is required to report income from the investment on an annual basis. There are three different forms of revenues that can be generated in mutual fund, and each is taxed very differently. So mutual funds, those who have bonds in them, fixed income investments in them, they provide you interest income. Mutual funds who have preferred and common shares in them, they provide you dividends. Mutual funds, right, who sell stocks, right, or sell investments and they make some gains, they report capital gains to you. Also, you can sell mutual funds and make some profits. So capital gains are generated in a mutual fund context in two ways. The mutual fund itself can sell some stocks, right, and make some money on them. That is reported to you as capital gains. Or you as an investor can buy mutual fund, let's say at $10 per unit. Then when it becomes $15 per unit, you can sell it. So these are two ways of making capital gains in a mutual fund. So three ways to generate income from mutual funds. Interest are, right, if the mutual fund is investing in bonds or other kinds of fixed income, it provides you interest income. Dividends, if the stocks, preferred or common, that the mutual fund holds, if they are providing you dividends are cash payments given by stocks, then that is dividend income. Capital gain, right, either you are selling mutual funds for profit, or the mutual fund itself is selling some investment that it has made for profit. Now, how are these treated? Interest income from investment, right, which is not in a tax shelter, that is, it is not in a registered account. So what happens when you get interest income? Taxpayers are required to report interest income from things like Canada Savings Bond, GIC's bond on an annual accrual basis. What does that mean? Whenever you get interest, you have to report it to CRA, right, in the year in which you have received it, regardless of whether or not, right, you get the payment in cash, because sometimes mutual fund have reinvestment plans. Whatever interest or dividend they pay, they reinvest that back into the fund. But even if they are reinvesting it, that is, you're not getting any cash, but you still have to report it. Now, important point, interest income is taxed as regular income. That is, whatever is your marginal tax rate, you have to pay taxes basis of that, and is not subject to any preferential tax treatment. Interest income is taxed at a very high rate, right, especially for rich clients that you will have, because you cannot take any tax credits, you cannot take any tax deductions. If it was dividend, you can take a tax credit. If it was capital gain, there is a capital gain tax deduction, but interest income, you cannot do that. Now, dividend from a taxable Canadian company which is not held in a tax shelter, that is, it's not a part of TFSA or an RRSP or an RRSP, then preferential treatment is provided on dividend investors that people get from Canadian company, because corporations pays those dividend from after tax profit. So why is dividend taxed at a lower rate? Because dividend is shared, the company shares dividend from after tax profit. So company has already paid taxes to the government, and whatever is left after paying taxes, it pays dividends from that. Okay, so government allows you to take a deduction for the taxes that the company has already paid. So that's why dividend appeared to be taxed at a lower rate. So how does it actually work? The amount of dividend is included in taxpayer income is grossed up to equal the approximately what the company would have earned before taxes. Then the taxpayer receives the tax credit that offsets the amount of taxes the company has paid. The eligible Canadian dividends are grossed up by 38% to arrive at the taxable amount of dividend. Then the taxpayer receives a tax credit of 15.02% of the grossed up amount. So I'll share an example of how dividends are taxed, and we'll contrast it to interest income. Okay, so continuing our discussion, let's say there are two options. You get $1,000 of interest income and you get $1,000 of dividend, and your marginal tax rate is 38%. So your client is in a very high tax bracket, right? How will it work? Now interest income, it's very simple. The tax that you pay is simply, or let's do 35% so that it doesn't get confused with the gross up rate. So tax rate is 35% for you. So you get $1,000 of interest income, you report to CRA. How much taxes do you have to pay to CRA? $1,000 multiplied by your tax rate, 35%, that is the tax payable. Interest income, no deductions available, no credits available. But if you get it as a dividend, right, then it's a different story. There are steps that you have to follow to calculate how much taxes you pay. Step number 1, gross it up by 38%. Okay, step number 1 was gross it up by 38%. So how do we do that? We multiply the dividend amount by 1.38. We multiply the dividend amount by 1.38. That is grossing it up by 38%. Step number 2, we calculate the taxes. Step number 2, we calculate the taxes. So 1380 multiplied by 35%, $483 is the taxes. Step number 4, we calculate dividend tax credit. Step number 4, we calculate dividend tax credit. Now it depends on what kind of investment you have made. If it is a public investment, that is an eligible Canadian company, the dividend tax credit is calculated as at 15.02%. Okay, so how do we calculate dividend tax credit? It is the grossed up dividend multiplied by 15.02%. So these two steps I'm going to again explain. Step number 2, right? Step number 1 was easy. $1,000 dividend you received, you gross it up. That is, you multiply it by 1.38. Step number 2 is we calculate taxes on grossed up dividend. How did we do that? So it is grossed up dividend multiplied by tax rate for the client. Okay, so tax rate for the client was 35%. So 1380, the grossed up dividend multiplied by tax rate 35%, that gives you taxes on grossed up dividend. Then you calculate the tax credit. Now how is tax credit calculated? Grossed up dividend multiplied by 15.02%. This is the tax credit. So 207 is the tax credit available. Step number 5 is taxes payable. So how do you calculate that? Step 2 minus step 3. This should be step 3, not 4. Okay, so 483 minus 207, 275 is the taxes that you have to pay. So there is a huge difference. Interest income, you paid $350 as taxes, right? Let's make it black and bold. In dividends, you paid $275 of taxes. So dividends are taxed at a lower rate. If you get the same amount of dividends as interest income, the taxes you have to pay on dividends will be lower. Once again, how did we calculate that? It's a 4-step process, not a 5-step process, 4-step process. Step number 1, gross up the dividend multiplied by 1.38. Step number 2, on the grossed up dividend, right, calculate taxes. Grossed up dividend multiplied by 35%. Step number 3, calculate the tax credit. grossed up dividend multiplied by 15.02. This is the fixed rate, right? So you have to remember that. Once you have that, subtract the gross taxes on grossed up dividend, step 2, minus the tax credit, step 3, you get the taxes payable. This is the taxes that you have to pay to CRA. So it is very evident that dividends are taxed at a lower rate. So you can see this example. So if you receive 300 dividend, right, we have to gross it up, that is multiplied by 1.38414, right? This is the taxable amount of dividend. You can claim dividend tax credit at 15.02%, $62. So right, 41 like, okay, then if you are taxed at 26%, the tax payable is 107 minus the tax credit, so $45.46 is the net tax payable. Better to do it using the method that I showed, right? You'll get the same answers. Please try this one out when you're doing it. Now, capital gains, you get a deduction, you don't get a tax credit. This is also tax advantage. So capital gains for investment not in a tax shelter, that is investment made outside of RRSP or TFSA. How will it work? For an investment generating capital gains, the taxpayer pays tax on 50% of capital gain. So this is called as the inclusion rate. Only 50% of capital gains are taxed, right? This rate has changed to 75% now. So going forward, this is going to be 75%. But for this taxation year, that is 2024, right, it is still 50%. The taxpayer sells the share. So I'll show you how it works and then we can go through. So let's say you equivalently get a capital gain instead of dividend and instead of interest and dividend, you get $1,000 capital gain. How will the tax work? Now, first of all, not the entire $1,000 is taxable. There is inclusion rate. Okay, let's say the inclusion rate is 50%. It has changed to 75%, but right now for this example, let's assume it's the previous one, 50%. So $1,000 multiplied by the inclusion rate, $500, this is the taxable capital gain. Rest 50% is not taxable. This is the taxable capital gain. Now from this taxable capital gain, right, you will have to pay taxes at your tax rate. So let's assume like our client's tax rate was 35%. So this times 35% is the taxes. So this is how capital gain taxation work, right? Whatever is the capital gain, you multiply it by the inclusion rate, you get taxable capital gains. Those taxable capital gains you multiply by the tax rate of your client, you get the taxes. So $175 is the taxes. So if your client gets $1,000 of interest, he pays $350 of taxes. If he gets $1,000 of dividend, he pays $275 of taxes. And if he gets $1,000 of capital gains, he pays $175 of taxes. So there is advantage to dividends because they get tax credit. There is advantage to capital gains because you have a tax deduction, because only 50% or 75% in the future, right, are included for taxes. So they have shown in calculation of $1,000. We just did that, right? So the capital gains will differ. The tax rate that they have assumed is 29%. We did the example with 35%. So you can just read through it and try this out at your own time. Now, there are certain, right, costs that can be tax deductible. Okay, so when you're in making investment, right, and it generates some investment income, then there are certain costs that you can claim as a tax deduction, so that investment income will go down. So interest paid on borrowed money to earn investment income, such as interest and dividends, is allowed to be taken as a tax deduction. This does not apply to tax shelters. So three situations we are going to discuss. If you borrow money and you make an investment in a taxable investment account, and that investment pays you dividend or interest, then whatever interest you pay on the borrowed money, you can claim that interest as a tax deduction against the income you have received from interest and dividends. So this was the first case. Second case, you borrowed money but you made investment that generates capital gains. Then you cannot claim the interest that you paid on the borrowed money as tax deduction, because capital gains, if you're getting, you're not allowed to, right, claim the interest as tax deduction in that case, because you're not getting an income, you're getting a capital gain. So capital gains are not allowed. The third case, if you're borrowing money and making investment in a tax-free savings account or in an RRSP or in an RESP, registered education savings plan, then whatever interest you are paying on the borrowed money, you cannot claim it as a tax deduction. So tax deduction is only available if you're borrowing money, the investment is made for interest and dividends, and you're making it outside of these accounts. So the account is not an RESP, not an RRSP, not a tax-free savings account. Then you can also deduct fees for certain investment advice. Then fees paid for management, administration, safe custody of investment is also allowed. Accounting fees that you pay to record investment income is also allowed to be taken as a tax deduction. The following charges cannot be deducted from investment income. Interest paid on money borrowed to buy investment that generates capital gains only. So if a stock only generates capital gains, you cannot claim the interest paid on that investment as a deduction. Brokerage fees or commissions that you pay to buy and sell stocks and bonds, you cannot claim that. Interest paid on funds borrowed to contribute to any of the registered plans like RRSP, RESP, RDSP or tax-free savings account. Administration, counseling and trustee fees for regular or self-directed RRSP or RRIF. So if you're paying for administration, counseling and trustee fees, it's not allowed. Fees paid for financial planning are not allowed. Safety deposit box charges are also not allowed. For many years it was okay, but not right now. Okay. Then when can you deduct interest paid on borrowed funds to purchase securities? If the taxpayer has a legal obligation to pay interest, so you were legally obligated to pay interest, that is, you borrowed from a financial institution, or even if you borrowed from your, let's say, relatives, but they were charging you a fixed interest, it was in the contract. The purpose of borrowing is to earn income, that is dividend and interest, not for capital gains. The income produced from security purchase with the borrowed fund is not tax exempt. In other words, it was not going to a registered fund, it was in a non-registered account. The next part is pension plans. There are two main types of pension plans in Canada: government pension plans, Canada Pension Plan or Quebec Pension Plan, and employer sponsored pension plan, right, which are registered pension plans called as RPPs. So let's discuss the government pension plan. So every resident in Canada earning income from your employment or self-employment is required to contribute to one of the two government pension plans. So if you're working in Canada, you will notice it. From your paycheck, the employer itself deducts a charge for Canada pension plan, deducts a contribution for Canada pension plan, right? If you're living in Quebec, the contributions do not go to CPP, but they go to Quebec pension plan. The residents of Quebec contribute to Quebec pension plan. Their benefits are identical to CPP. Now, what are the benefits? You make contributions in your working age. When you turn 65, you can start taking pension outs. Typically, the benefit starts paying when the person reaches the age of 65, but they can start to receive it as early as the age of 60, but a significantly reduced amount. So there is a age bracket. You can normally the pension will start at the age of 65. If you prepone that pension, if you prepone the withdrawals from CPP, that is, you can start to receive pension at the age of 60, the pensions will be lower. How much low? It's almost 40% lower. Okay. Same way, whatever pension you are going to get at 65, if you can delay it, right, to the age of 70, then you get higher amount. How much higher? Almost to the extent of 40% higher monthly. Okay, depends on the calculation. I'm just giving you a gross idea. So 60, the pensions will be lower. At the age of 70, the pensions will be higher. In addition to CPP and QPP, a person is eligible to receive old age security, right, when they turn 65. Old age security is an additional plan to CPP, right? Old age security does not depend on contribution. It depends on how long have you been residing in the country. Okay. Since the old age benefits are not paid until the application is made to receive them, the applicants for the old age security should apply 6 months before they are eligible to receive benefit. Old age security is based on income though. If your retirement income is above a certain threshold, right, they will start reducing the old age security benefits. That is called as old age security clawback. So certain people will experience the OAS clawback when their total income in the taxation year is more than a certain amount. So what does this mean? Whatever old age security you receive, you have to pay some part of it back, right? Paying back 15% for every old age security dollar above that threshold. But if your net income is above a certain limit, right, the limit is mentioned, right, the old age security benefits becomes zero. So old age security is not available for people who are above a certain threshold. Okay. This has nothing to do with contributions. This is paid to everyone who has been a resident for a certain number of years in Canada. Then your client or you might also have a pension plan with their employer. Those are called as registered pension plans, RPPs. These are plans that employers have. A registered pension plan is a trust registered with Canada Revenue Agency, established by a company to provide pension benefits for his employees when they retire. Both employer and employee contributions to the plan are tax deductible. There are two types of registered pension plan: defined benefit plan and defined contribution plan. So when you work with an employer, they might have one of these two. Defined benefit plans are more common in union jobs. So if you're working with the federal government or provincial government, or let's say a unionized environment like universities and stuff, they most likely have defined benefit plans in which the pensions you're going to get is already decided, is predetermined based on the formula, including how many years of service you have provided, what is your income level, and other variables. Then there are second type of plans, more common with the private employers. So example, if you're working with a bank, Royal Bank or TD Bank, right, you might have a defined contribution plan in which the contributions are predetermined. So most employers will match the contributions that you do to the pension plan. So let's say you contribute 10%, they will match 5%. So 50% of that. So you contribute $10,000, you get $5,000 from your employer, and both these funds are invested right in a plan that has most likely mutual funds and stuff. So these are also known as money purchase plans. Contribution to the plans are predetermined, but the benefits are not. Benefits depend on how much returns those plans generate. So benefits are not certain in a defined contribution plan. So to be received at retirement will depend on how the contributions were invested. Okay, now defined benefit plans can be of three types. Now calculations might be asked in the exam, so we'll also see an example. So defined benefit means the benefits are already fixed. The pension you're going to receive is already fixed. So it can be a flat benefit plan. What is a flat benefit plan? Usually a specific amount of pension for each year of service is already fixed. For example, you get a pension of $15 per month for each year that you work. So if you work for 30 years, you're going to get a pension of $450 per month. How is it calculated? The amount of pension per month multiplied by years of service. So the benefit of flat plan, right, does not depend on right income level. So two employees of the same company with very different income levels will get the same pension. The problem is the benefits might not keep pace with inflation. So the union has to renegotiate this $15 payment every time they go into negotiation, because this $15 might not be enough when you retire. Then second plan is career average. So what happens? You take an average salary over the period that you have worked with the company, and you multiply it by the plan rate. So example, usually a percentage of employees' average earnings over the course of their career is taken. Example, a 2% plan would, for a person who has earned an average of $1,000 per month over the 30 years of service, would receive a monthly payment of $600. What does this mean? So if you have worked for 30 years and your average salary was $1,000 per month, then you get 2% into 30, that is 60% of your average salary. Average salary was 1,000, so 60% of 1,000 is $600. So you take average salary per month of the entire period, you multiply it by plan rate and multiply it by year of service. Again, this is a problem because you might grow in your career a lot. Initially, when you started working, let's say you started working with the federal government, you were paid $40,000 of salary, but then you upgraded your skill sets. You did, like, let's say a master's degree, and eventually you got on to 150,000. But if you take career average, then the average will be quite low than your last drawn salary. So this is a problem with the average plan. So that's why final average is more popular. It is similar to career average. This type bases the payment on average earnings over the last 5 years of service at a specified percentage for the total years of service. For example, only last 5 years will be taken. So let's say last 5 years was $54,000 that you earn, and the plan rate is 1.5%. So 1.5% multiplied by 30 years multiplied by 54,000 will be, right, divided by 12 will be your monthly pension. The problem with final years is sometimes your earnings might drop a lot in the last year because you might work part-time. So if that happens, then the plan might play you a very low pension. So you have to be very careful what is the last 5 years salary when you're retiring. most people have this plan, so be very careful for working part-time very close to the retirement. So defined benefit plans, they contain important advantages and disadvantages of flat. We discuss it. Try not to memorize the information given in the book, just be able to understand it. Defined contribution plans, these are where the benefits are not fixed but the contributions are fixed. So you contribute a certain percent, a fixed percent. The employer usually matches that contribution. Those get invested, right? And whatever amount you get on retirement, that is basis on investment. The employer contributes a fixed percentage based on employees' annual earning. The employees contributes a percentage of their salary and employer matches it. The pension is based on amount of money a plan member has in their retirement account at the retirement. This amount will be very different depending on the amount contributed and the investment retired over the lifetime of the plan. Just to show you an example, let's say the plan that you have is you contribute $10,000. This is your yearly contribution. Okay, and your contribution is matched by your employer. So let's say employer puts in 50% of your contribution, so $5,000. So the total contribution that goes into the RPP, registered pension plan, provided by your employer is $15,000 per year, out of which $10,000 came from you, $5,000 was provided by employer. So this is invested every year. Let's say the rate of return the plan generates is 6% and you invest for 30 years. So when you retire, you will have some money in that retirement account. So I'm just showing you a rough calculation. Calculation is not important. So 6% for 30 years, payment amount is $15,000, right? 0, and let's say end of the year it is invested. So you will get almost $1.2 million in your retirement fund. This depends on the investment rate, right? So if the fund generates 6%, this will be amount. If the fund generates 5%, the amount will get lowered. If the fund generates 7%, the amount will be higher. So the retirement fund that you might receive depends on the investment rate and the contributions you make. So the contributions are fixed, but the end benefit is not fixed. So example, the combined employer and employee contributions to these plans cannot exceed, right? So this is the limit, like this is the statutory limitation. It cannot be more than 18% of employees' current year contributions. So it cannot pass 18% of whatever is your salary, and the DC contribution limit for the year, which is 29,000. So every year the government will show how much total contribution, maximum total contribution can the plan make. So the contribution that will go into the plan will be lower than the stated amount or 18% of your salary. So this number changes. This is based on 2021. So every year it changes. So for 2024, RRSP limit and this limit is same. So it is $31,000. Okay, $31,560. So this amount is indexed to inflation. So each year it changes. Now, along with employer plan, you can start your own plan also, and I encourage you to start this for your clients as well as for yourself. So what are tax deferred plans? The tax deferred plan is you don't pay taxes every year. Those taxes are deferred to the time you withdraw, or sometimes the tax are not there at all, right? So the principles of tax deferred plan is to encourage Canadians to save for retirement by enabling them to reduce taxes they pay during their high years, right? And so the concept is simple. When you contribute to these plans, you don't pay taxes right now. Might be you might save on taxes. In example, in RRSP's case, you save on taxes. But when you retire, when your income is not that high, you withdraw from those plans. The withdrawals are taxable income, but the taxes might be lower because you don't have any other source of income. The payment of tax is tax deferred, that is delayed until the retirement years when their income and taxes are normally lower. The main plans are RRSPs, RRIFs, tax-free savings account, RRSPs, and provincial RPPs, that is provincial pension plans. So these are some of the plans available. So what is a registered retirement savings plan? So annual contributions are tax deductible up to the allowable limits. So whatever you contribute into this plan, you get a tax deduction, right, based on your contribution and your income. Okay, so your taxable income goes down. Income earned in the plan accumulates tax-free, so it grows tax-free as long as the investment and their income remain in the plan, right? But when you withdraw from the plan, when your retirement, right, those withdrawals become your income, so you have to pay taxes when you withdraw in your retirement. There are two main types of RRSPs. You can have single vendor. So single vendor means the holder of the plan invest in GICs, segregated funds, or mutual funds. The investments are held by a particular bank, insurance company, credit union, or trust company, and no day-to-day decisions are required to be made by holder. Most of the time, if your employer is providing an RRSP plan, it can be a single vendor plan. So you contribute into the plan, but you don't really make where that contributions are going. They go most of the time to a specific mutual fund. Self-directed plan, right? These are administered by financial service companies, but the decisions are made by the holder, who is free to invest in a wide range of investment that they want, that can be held in the plan, including foreign investment. So self-directed plans, you get to control, right, where you want to invest. Now, what is the contribution to RRSP? There is no limit to number of RRSPs you can have. You can have multiple RRSP account, but there is a limit on how much you can contribute on a per year basis. It is usually lower of the two, 18% of your previous year's earned income, or the RRSP contribution limit for a particular year. 2021 it was 27,830. In 2024 it was 31,560. So whichever is lower, 18% of previous year's income or 27,830. So example, if your income is, let's say, $120,000, right, in previous year, so this is 2024, so 2023 income becomes eligible. So you have to calculate 18% of that. So 120,000 multiplied by 18%, 21,600, and you have to compare it to the 2024 limit. The limit was 31,560. So I'll copy paste this. Now whichever is lower, you will go with that. So in this case, the lower amount is 21,600. So you can invest this much. If your income was, let's say, $240,000, that 18% of that becomes 43,200. Then you will go with this or the limit, whichever is lower. So you will go with the lower amount. So depending on your income, you either go with 18% of that income or the stated amount, whichever is lower. Unused contributions, if you have not used the contributions, they can be carry forward indefinitely, right? Now, what is considered to be income that is eligible for an RRSP contribution calculation? So you can add up your total and employment income less any union or professional dues you have paid. You can include net rental income, net income from self-employment. You can include royalties from published work, inventions, research grants, etc. You can include court-ordered alimony or maintenance payments. Disability payments are eligible. Supplemental employment insurance are eligible. Important point, EI is not eligible, right? You cannot include your EI payments, right, for an RRSP contribution. So the 18% that we just saw is 18% on all of these except EI. Now, sometimes you might over contribute into an RRSP. So over contributions up to $2,000 do not have any penalty. But if you over contribution exceeds more than $2,000, you will be charged penalty tax of 1% per month on the amount over $2,000. So example, so let's say you contributed $4,200. This was your over contribution. So whatever was your limit into an RRSP, you contributed $4,200 over that limit. Now how much is allowed? $2,000 over contribution is allowed. This is the allowed limit. Allowed over contribution. Okay. So how much over contribution is above that limit? So above the $2,000 limit. So you have contributed $2,200 over the $2,000 over contribution limit that the plan had. So once again, you contributed $4,200. So let's say you were allowed to contribute $20,000. You contributed $24,200 into an RRSP. So there was a $4,200 over contribution. Allowed over contribution is only $2,000. So $2,200 is above the limit, above the $2,000 limit. How much you have to pay penalty? 1% of that. So your penalty will be 1% of 2,200. Your penalty will be 1% of 2,200, right? And you have to pay that monthly. So $22 penalty you have to pay monthly. This is the monthly penalty that you have to pay on the over contribution that went into RRSP. Now, along with cash, you can also move your stocks and stuff. So persons can contribute securities that they already own into their RRSP, and these contributions are called as in-kind contribution. So you can transfer your stocks from your taxable account into an RRSP. But the securities contributed are considered to be deemed disposed. That is, you have to pay taxes on whatever gains you have made on those securities before those securities are transferred. The deemed disposition must be done at fair market value, and it can trigger a capital gain or a capital loss. Any capital gain has to be included in person's taxable income in the year, right? Example. So if you have a $2,000 Royal Bank stock in your non-registered account, you want to transfer this to your RRSP. So what will you do? First of all, you will calculate the taxes on that. So you bought this stock for $1,500. So you had a capital gain of $500. So this was the purchase price. This is the market value. So you report this capital gain, right, in your income, and then you transfer this $2,000 stock into an RRSP. This is how it will work. Now, this is an important consideration. Then if you have some room in your RRSP, you can use that room and contribute to your spousal RRSP too. So if you have a spouse and you have a $2,000 room in your RRSP, instead of contributing into your own plan, you can contribute into their spousal plan, right? So a person can contribute to a spousal RRSP and still claim the tax deduction, but is subjected to the same maximum limit as if they were contributing into their own RRSP. So you can contribute subjected to you have room in your own RRSP limit. Why would you do that? Because your spouse might be at a lower tax bracket than you are, and they might not have enough retirement savings. So this is a good strategy if they don't have that. Unless withdrawals from the spousal plan are made by the spouse into an RRIF or an approved annuity, the withdrawal amount is taxable income to the spouse and not to the contributor. So when you contribute into a spousal RRSP and eventually they retire, they can take that contribution as their income. It will be not taxed to you. However, there is a restriction. Any withdrawal of contribution to a spousal plan claimed as tax deduction by a contributing spouse made in the year of contribution or 2 calendar years before the withdrawals are taxable to the contributor in the year of withdrawal. So I'll explain this example. So let's say we'll draw a timeline for 8 years. So you have been contributing $500. Let's have a couple. So Harry and Kathy. This is a couple. Harry is contributing into Kathy's plan $500 every year. So this is a spousal contribution. Okay. So he has been contributing for the last 7 years. In the 8th year, Kathy decides to withdraw all money. So how does the taxation work? So whatever Harry had contributed to Kathy's plan in the year of withdrawal and 2 years before that, in the year of withdrawal and 2 years before that, okay, that is taxable to Harry. Okay, rest of it is taxable to Kathy, his spouse. So once again, Harry is contributing into Kathy's spousal plan $500 per year. In the 8th year, he made no contributions to the plan, but Kathy withdraw all the money. So what will happen? The contribution that might have happened in the 8th year, fortunately there was none, right? And the contributions that happened in the previous 2 years will be taxed to Harry as income. So this will be Harry's income. Rest of it will be taxed to Kathy as income. So I'll just do sum. This will be Kathy's income. This will be Harry's income, right? They will show and they will pay taxes on that when they withdraw money. Now, you have to terminate RRSPs once you turn a certain age. The holder of an RRSP can make withdrawals from their RRSP anytime they choose, but they must deregister their plan during the calendar year in which they turn 71. You have certain options. You can withdraw the proceeds in lump sum. It becomes fully taxable as your salary. You can purchase a life annuity. What is a life annuity? It pays you a monthly pension until you're alive, right? Pays tax only on the annual payment. Or you can purchase a fixed term annuity, which pays you pension for a certain number of years, right? That also you have to pay taxes on yearly payment. You can transfer the fund to an RRIF and take annual income. RRIF is self-managed fund. You can transfer RRSP's money into RRIF and then you're forced to take annual income, right? There are rules about that, with the balance of fund or investment remaining in the tax shelter. You can combine any of those above. Okay. What is the advantage and disadvantage of an RRSP? Advantage, it reduces annual tax income based on contribution. So whatever money you contribute into an RRSP, your taxable income goes down by that. Okay. It shelters certain types of income from taxation, right? So don't have to pay taxes every year. You can accumulate funds for retirement, deferral of taxes until the holder is in lower tax bracket. So if your retirement income for people is usually lower than their earning income, so you pay taxes at a lower tax rate. There is opportunity to split income. So whatever RRSP pension you have, you can split it with your spouse. So it will be taxed at a lower end, right? And also you can get a $2,000 separate credit. So every retired person can get a $2,000 credit. So if you can split your income with your spouse, they can claim that $2,000 credit too. There are certain disadvantages though. Withdrawals are subjected to income tax, right? So whatever you withdraw, treated as income, you pay taxes on that. Holders cannot use dividend tax credit, right? So there are no tax credits available. If the plan holder dies, payments are subjected to tax as income of the deceased unless the funds are received by their spouse. So if a person dies, whatever RRSP they have, it will be treated as income in the year of death unless and until that plan gets transferred to their spouse. RRSP assets cannot be used as collateral for any loan. RRSP holders transfer the RRSP assets. Next point is registered retirement income funds. These are plans that you open after you close your RRSP, right? Whatever money you have, you can transfer it into this plan. RRSP holders transfer the RRSP assets into an RRIF and continue to shelter those assets from taxation. Each year, the holder must withdraw certain minimum amounts from their RRIF and pay income taxes on them. The minimum withdrawals start at 5.28% at the age of 71 and increases by the annual increment to the age of 95 when it is set at 20%. The each year amounts is determined by the table, right? This is the table which shows you how much withdrawals can happen each year. There is an annual minimum withdrawal, but there is no maximum withdrawal limit that you have to face. So every year from RRIF, you have to withdraw a certain percent of income. You are forced to do that. Now, sometimes you might leave an employer. They might have an RRSP plan or a pension plan, and you are leaving that employer. So what do? They usually transfer those plans into a locked-in retirement account. It's typically used when person leaves an employer with whom they have membership in a registered pension plan. Often the person leaving the company can transfer their pension credits money into a locked-in RRSP, which gives them the same opportunities and responsibilities as with an regular RRSP, except the holders cannot withdraw fund until they reach a particular age, depending on the province and the province of the plan. At the time, options are generally limited to life income fund or a life annuity. So you can transfer your pensions to a locked-in retirement account. The account will continue till the retirement age, after which you have to purchase like a life annuity, which gives you a yearly pension. Tax-free savings account. So this is a very interesting account. Whatever money you have in this account, which is invested in any stocks, bonds or mutual fund, it grows tax-free. There is no taxes on whatever growth happens in this account. So income earned on funds within the TFSA will not be taxed in any way throughout the holder's lifetime when they are withdrawn. There are no restrictions on timing or amount of withdrawal. You can withdraw it any time, before or after the retirement, doesn't really matter. Holder does not have any earned income to make deposit, right, and must be 18 years of age. So you need to be 18 years of age to open a tax-free savings account. Every year the government gives you a certain limit, right? Your annual contributions are limited. Annual contribution limit for 2021 was $6,000. For 2025, if you check, 2024 if you check, it is $7,000. 2024 is $7,000. So this annual contribution limit you get, right, and you can invest within that. Unused contribution rooms can be carried forward without any limit. Earned income in TFSA is not subject to income tax. Eligible investments are basically the same as those that can be placed into an RRSP. The next account is Registered Education Savings Plan. This is an account here that you open for your kids. The advantage is whatever money you accumulate in this account, that money can be used by your kids for education. So the kids have to pay taxes on that amount. You don't have to pay taxes. They make withdrawals, they pay tuition fees and stuff. So they show it as their income when they go for their education. So it might be taxed at a lower end in the hands of your kids. Second, the government pays you certain grants. That is, they match your contribution up to $500 or $600. $600 for low income people, $500 for everyone else. The contributions are matched up to 20% is the matching rate. So contributions into RRSPs are not tax deductible, but the income they create accumulates tax free. On withdrawal, the portion of payments that were not the original capital, so the growth, will be taxed in the hands of the beneficiary. There is no maximum that can be contributed in a single year, but there is a lifetime contribution limit of $50,000 per kid. The plan must be collapsed at the age of 35, right, when the kid turns 35. To provide further incentive, the government makes matching contribution, that it matches your money. So on the first $2,500 that you contribute, they match 20%, right, each year to an RRSP for a child that is below the age of 18 years. Depending on the family income, an additional amount may be available. The additional amount is up to $100. The total lifetime grants can be received $70 to $100 maximum. The CEGS money must be repaid to the government if the child does not go to attend eligible post-secondary school. It has to be returned if the kid doesn't go to school. So how it works, you should open an account if you have kids. It's very interesting. So let's say in an RRSP account you contribute $1,000 and you are in a high income tax bracket. So what will happen? The government will match 20% of that. That is, $200 will be given to you by the government on $1,000 yearly in the year that you put in. The maximum they will match is $500. So if you put $2,500, then they will match 20% of that. So they will provide you $2,500 your own money, $500 as grant. So total money that gets invested is $3,000. Okay, 25 your own money plus 500, 3,000. In this case, total money that gets invested is $1,200. 1,000 was your own money, 200 was the grant, so $1,200 gets invested. So this grant is very interesting. You should utilize that. What happens if you invest $3,000 into an RRSP? The matching rate is 20%, but they match maximum 500. So if you calculate 20%, that will come to $600, but they will not give you $600. They will only give you maximum $500. So the amount, that total investment, $3,500. This was your money. This was the grant received, right? This is the money that you get. If you are below a certain income threshold, they give you $100 extra, so $600. Next is pooled registered pension plans. This is mostly given to federal employees and employees of certain provinces. So this is designed to address the gap in employer pension plan coverage by providing Canadians with an accessible, low cost and large scale pension plan. PRPPs will hold assets pooled together from multiple participating employers, allowing workers to take advantage of lower costs that the larger plans get from economies of scale. Like an RRSP, contribution limits are limited to the available contribution room based on earned income. Contributions are tax deductible and funds can move when the person changes employers. PRPPs are administered by eligible financial institutions such as banks and insurance companies. Okay. So you can check how long your retirement savings and investment will last. So this is an example. So investors will try to plan how long their retirement savings and investments will last them once they have retired. This is a tool that can help you out if you're interested. So will the money last, right? So you put in how much is your investment balance, what is the rate of return, how much annual income you want, what is the inflation, right? And it will give you how long will your money last. So very interesting thing to check out. Tax-free savings account, like this is the annual limit. Right now it is $7,000. So every year it goes up based on inflation. So that covers the topic.